This
Economy is.
conference will now be recorded.
It is being recorded, and I will also go through some of the virus data because this is not a economic or a financial crisis, but rather a biological one with economic and financial consequences. So the way that we're thinking about the current situation, first, I think we have to kind of admit up front that it's really hard to model this current situation. We've got to, kind of have a lot of humility with the forecast. There's the old joke with economists that they use, how bad do you know their forecasting is? They use decimal points. We're not that accurate, and the uncertainty right now is clearly quite high. But in terms of thinking about the kind of the future, I've been encouraging people to think about in terms of the next 2 months, the next 2 quarters, and the next 2 years. And I'll walk you through those particular boxes in terms of what to expect. The stock market is always a leading indicator. It's not a reflection of the overall real economy, but it's often correlated with it. And of course, we saw the stock market decline in March and then rebound in recent weeks as we've gained certainty. And so it's really kind of a challenge to try to gain certainty about the virus and then how governments are going to react to the virus. We're watching the supply chain impacts. We're clearly watching consumer confidence. So that's going to be a big issue as we go forward. But in general, the forecast I'm going to walk you through has a sharp mid-year decline and then a bounce back after. So let's start with 2-month considerations. We know we've got events, school and business closures, a lot more people working at home, but I think it's really important from a strategy perspective to keep in mind the idea that this kind of lockdown, shutdown period for the economy is just a temporary pause. It can't be permanent policy. The economic consequences are really too large. And what we've effectively done through government fiat is put the economy into a medically induced coma in order to ramp up the medical infrastructure to deal with the virus. Of course, also in the short run, in most states, all but 6, home building and remodeling has been deemed an essential service. So home construction that had already begun, for the most part, is continuing. And it is one of the parts of the economy that's essentially still operating. So if we think about those parts of the economy that have really been shut down, this is the consumption share of U.S. GDP. It's 2/3 of the U.S. economy is on this pie chart. And the parts of the pie chart that are in darker colors, dark brown and dark blue, are the more resilient parts of the economy. There are things like healthcare and housing, utilities that have not been slowed down or affected by the shutdowns. If you look at restaurants, accommodations, recreational services, those are the most strongly affected parts of the economy, and they represent about 10% of the consumption list. And those are the parts that have been hit the largest, but what we've seen as this period of time has been expanded and extended is that overall you're seeing impacts throughout the entire pie of this particular consumption part of the chart. So it's what we're discussing in terms of we've got to make sure this is not a permanent solution. And we know this is temporary. It's unavoidable to try to talk about the economic forecast without talking about the virus. You've seen some version of this, the idea of flattening the curve, that in the red area you get a lot of virus infections in a short period of time. It overwhelms the healthcare system capacity. And so through social distancing and shutting things down, we spread things out. Now, if you're a public health official, that sounds great. But of course, the longer this stretches out, the greater the economic consequences. So I wish economists had a little bit more kind of more to say in terms of this debate on whether we shut things down or whether we open them back up. And that's why at the top of this slide, I say, well, yeah, we need to flatten the curve, but let's raise the line too. It's that dashed line that's the healthcare system capacity. And so in the short run, we've got to use this time effectively to ramp up the healthcare system so that we can open up the economy again. And the thing I've been pointing out, and there's some sort of scary articles from civil liberty perspectives of how China has dealt with this, and I don't believe any of the China data. I don't think you should either. But a lot of things of, if you're in public and you test positive for a fever, off you go to a fever hospital. Well, we're not going to do that in the United States. How we beat challenges, things like World War II, is science and capital through markets. So raising the line is the deployment of science and capital. And ultimately, whether it's through antiviral drugs or a vaccine, that's how we're going to beat this, not through reducing civil liberties. So that's the 2 month bucket. What about the 2 quarter perspective? Well, the 2 quarter perspective is where we get stability in the economy going forward. I think that's a period of time, and we're starting to get close to this, where virus cases subside in terms of the growth rates of the virus. Financial markets are stabilizing, and we see that in credit markets and in the stock markets. The economic data are going to be terrible. There's no getting around that. The second quarter is going to have historic declines by design, right? The government officials have put the economy into a recession in order to accomplish some distancing. We do think that we're going to see a decline in the third quarter, that we're not going to get a V-shaped rebound for the overall macro economy, but eventually we are going to get a rebound by the time of the fourth quarter. In the meantime, we've got aggressive fiscal policy, a lot of government spending, some of it good, some of it bad. That's something we can talk about. The Federal Reserve is all in on financing stabilization. And I think the Federal Reserve actually deserves an A plus in terms of its ability to maintain credit markets, maintain liquidity, and basically underwrite this current period so that once we get to a period where the economy can open up and rebound, that financial conditions are in shape such that we can grow again. And I think the Fed has actually done a pretty good job. So in terms of the 2 quarter perspective, we think we're going to spring forward, but unfortunately that's going to be after the fall, not in the spring going forward. And as I mentioned earlier, we've got to deal with the virus itself if we're going to do any kind of forecasting. I spend my evenings looking at virus data so that we can adjust our forecast and economic outlook. If you listen to the media, one of the concerns is the idea of exponential growth for viruses. And the argument goes something like this. If you take a look at the red line, that's unchecked exponential growth. The virus spreads through a population with growing speed and eventually gets to everybody. That's certainly the sort of the cable news, mainstream media type perspective. Well, if you look at the scientific literature, that's not actually how viruses spread. They get to something called herd immunity, which is when a certain segment of the population, maybe 50 to 60%, is exposed. There's lots of antibodies. There's growing evidence, by the way, that maybe 20% of New York State actually has antibodies right now, which is a pretty high number. But these viruses don't spread on an unchecked exponential curve. They move along the blue line, which is what's called an S curve. And we're riding the S curve right now. So if we look at the historical data in the US on this slide, the red dotted line is an exponential curve that based on the initial data and maybe some of the more scary projections on how things are going to move with the virus. The blue line and green curve is the S curve. And the blue line is the historical data. And that's what we're growing on. We're growing along this S curve. So I think we're near a point where things are going to begin to slow down. I think the weather and sunlight is going to help. Certainly, we see more growth in the virus in the northern part of the country. I think that is evidence of seasonality. And I think that's going to play into some of the decisions on how we open up the economy going forward. All right, so I talked you through 2 months, 2 quarters. Let's think about 2 years. Well, it's probably going to take about 2 years to really deploy a vaccine. And that's really the ultimate solution with that in terms of the virus itself. I think over the next 2 years, it's going to take that long to get to a period of time where we're normalizing interest rates. So they're going to be low until then. And then that third point, this is kind of tongue in cheek, but we've been waiting for some increases in birth rates in the United States. The last 4 or 5 years, we've had the lowest since the Great Depression. So maybe we see a baby boom coming out of this. It would certainly be good for housing demand. Other people have told me when I do these presentations that, well, maybe we won't see a baby boom. We're going to see an uptick in divorces because everybody's trapped together. Well, either one would be good for housing demand, to be cynical about it, but I'm counting on maybe a baby boom. On the other hand, that fourth point is something I'm concerned about. I've called it checkerboard type pauses. Another way to think about it is a W-shaped recovery. If it's true that the virus is seasonal, it could be that the summer and early fall are pretty positive for the economic outlook, but then when we get into the late fall and the winter, we get outbreaks again. And then the thing to be worried about is localized shutdowns, which affect the economy. I am concerned about that. I think there's some evidence that suggests the virus is seasonal and that it could actually happen as we go forward. And then over the next 2 years, changes for how we live. I think one of the lessons from this is that being in a super high density environment like New York City and having to take the subway and being trapped in a small home that you rent is probably not the best outcome for a public health crisis. And I do think that is going to increase the demand for people who can afford it, for larger homes, for home ownership, and for lower density environments. And so we would see people who are able to telework, who don't have to commute as much, drive till they qualify even more. Or for those who are in the inner suburbs, maybe they will remodel and try to add a home office or a home gym. I think those kinds of changes to design and consumer preferences will have impacts on housing demand as we go forward over the next 2 years. All right, so one last thing on this. This is the virus data again. We pulled this from a scientific paper that came out at the start of March, and I found it really interesting. The black circles are virus outbreaks, centers of them. So places like New York, Seattle, Italy, we should probably add Spain, Iran, China itself, South Korea, and Japan. And they have something all in common. They're all kind of in the same temperature bound. So, you know, the yellow areas represents kind of a common temperature area. You don't see a lot of breakouts where it's really warm. And I think this is strong evidence, and the paper makes this argument that the virus is like other respiratory viruses and it's seasonal. So the good news on that is we're likely to get a reprieve in the short run. The long run, potentially more negative, which is we're likely to see some outbreaks as we go into the fall and the winter. That's why it's so important that we raise the line in addition to flattening the curve. We need to use this time that we're going to get to increase our hospital capacity so that we don't have to shut down the entire economy to deal with something that may prove, if lots of people have actually been exposed to it more than the actual counts, to be not the flu, more serious than the flu, but maybe not have a 3% fatality rate like the World Health Organization initially estimated. And I think that's too high. All right, so let's get into the data. That's just kind of some of the principles behind our forecast. The first quarter of 2020 is going to be negative. The second quarter is going to be historically negative. Our current benchmark forecast, we have about a 21% negative growth rate for the second quarter. That is that deep blue decline after the red forecast line. This is going to be the worst quarter that we've had since World War II, without a doubt. And it's by design. The government shut the economy down. This is not an economic or financial issue. It's by design. The economy the government shut the economy down. Unlike some forecasters that have really severe second quarter decline, I do think the third quarter is going to be negative as well. There are some forecasters who are saying that the third quarter will be positive. I don't think so. I think some of those forecasts are based off the idea that the stock market has rebounded, that they can see some rays of sunshine, and they think once things open up, we'll all get back to normal. Well, that's easier said than done. A lot of small businesses will be hurting. The unemployment rate will be high. I think lingering economic weakness going into the third quarter. But then I have a very strong rebound beginning with the fourth quarter. So again, this assumes we don't get a large bounce back because of that seasonality, just based on the economic fundamentals. And I do think that we're going to have growth and momentum headed into 2021. The unemployment rate is undoubtedly going to go up. We've had 26 million initial jobless claims over the last 5 weeks. That alone is enough to get us to an 11 or 12% unemployment rate. Our model suggests 14, but I got to tell you, I think 14 might actually be the low end estimate. I can see the calculations, the data, that the unemployment rate could on a monthly basis, maybe not a quarterly basis, but a monthly basis, get as high as 20%. And again, that's just a function of the fact that so much of the economy is in a shutdown mode, and the layoffs have been so high. But, and I put this on this next slide, unlike other recessions, well, the red line is going up a lot and it's going to get much higher than what we've seen over the last few decades. It should come down a lot faster. Not right away, but it should come down faster. Now, to put this in perspective, in the fourth quarter, according to our macro model, we've got the unemployment rate coming down to about 10% at the end of 2020. That 10% will be equivalent to near the peak unemployment rate of the Great Recession. If you look at the 2009 area where the unemployment rate peaked out on that red line, that's about 10%. So that's where we're coming down to. So we're going to experience a period of time for, again, 2 months, and that 2 months, 2 quarters, 2-year perspective, where the unemployment rate's going to be a lot higher than it has been of recessions past. But I do think it's going to come down a lot faster, certainly than the Great Recession or prior business cycles, because of the fact that the economy was turned off due to policy. The Federal Reserve is all in. I give a lot of credit to what the Fed's done so far. I give them a grade of an A. Interest rates are low. They have opened up a number of lending facilities to make sure businesses can get through this. I think they've been creative. I'm not worried about inflation. I'm worried about deflation right now, the decline in prices due to the reduction of economic activity. And I think the Fed has basically been as aggressive as we wanted them to be. And again, creative in terms of finding ways to make sure we don't face a liquidity crisis. As a check on that, the 10-year Treasury rate, yes, it's below 1%, but it seems fairly stable right now. And that really is a credit to the Fed. The impact then on interest rates, the 30-year fixed rate mortgage, which is in red here, is a little bit below 3.5% right now. I think it's going to basically be in that range over the next 2 years. I think that the Fed is setting the conditions where interest rates are going to be stable, predictable, and low for the next 2 years as we get into or go from a stabilization mode and get back into a recovery mode for the economy going forward. All right, what about the supply side? Well, we've been polling NAHB members, and by the way, thank you for your membership in the local, state, and national associations. It really is important at times like this to kind of not only be a member but help out on the advocacy side. And I'll mention some of the benefits that have come from that thus far. But this is a data that we took from online polling of NAHB members, looking at the impacts of the virus on business activity. The top impact so far has been traffic of prospective home buyers. 96% of builders saying they've seen declines in traffic, with 72% seeing significant declines. You can see some of the other impacts there. I think, in terms of thinking about policy implications from the current situation, it's taking longer to get plan reviews. It's more difficult to get engineering inspections to finish construction projects. If you look at the last item on this list, we've got supply of building products and materials. 72% of builders say that is an issue right now. We're hearing about some localized regional shortages in things like lighting fixtures, plumbing fixtures. I've heard about kitchen cabinets, floors, those kinds of materials. There's a lot of materials that are imported into the US for construction purposes. And the supply chain right now, particularly globally, has been disrupted. And so I would not be surprised that share goes up. The other factor that I think is likely to go up over the next 2 quarters is the last item on this list. And that's the ability to obtain new business loans. 50% of builders right now are citing that as an issue. I do think that the credit box lending for small regional builder or regional bank builders for A, B, and C loans is going to tighten up. And there's 2 reasons for that, by the way. One is the macro environment. Banks tend not to like when there's macro weakness because they have higher risk. The other factor is outside of the virus itself, we're going through an oil crisis right now. Oil prices are way, way down. We saw some negative prices for futures markets, which is really, really unique. And a lot of smaller community banks, regional banks, have exposure to energy development loans. As a lot of those loans go bad, those banks are going to be required to pull back some of their lending. So that's something from an advocacy side point of view that NHB is working on to make sure that the credit is available to builders. If we're going to lead the recovery, and I do think that construction and home building can breathe the recovery and a rebound, we got to make sure that the financing is available, particularly for small businesses as we move forward. All right, I mentioned the supply chain being disrupted. We took some data in March. 21% of builders were reporting various kinds of supply disruptions. That share has clearly gone up. And then we did some research that shows that about $65 billion of residential building material products were imported into the United States. And we broke that out by shares from countries. 31% of those imports came from China. And yes, China's in kind of a recovery mode, but the reason that that's important in terms of that share being particularly large, their manufacturing economy really shut down much earlier than the rest of the world. And we're beginning to see some of the ripple effects from that disruption in Chinese manufacturing. I do think that one of the things that's going to happen as we come out of this is a broadening, a diversification in our supply chain. I think we're going to rely on China less. That doesn't necessarily mean everything is going to be domestically manufactured, but I think we're going to be seeking out other countries in order to look for places where we get some of these products. That too much reliance was made on China, not just in residential building, but in things like pharmaceutical manufacturing and other kinds of product construction and building. So I think that Chinese share is going to go down as we move forward. In terms of lumber pricing, we always watch lumber pricing in terms of home building. As you all know, 2018 really kind of experienced some dramatic increases in lumber due to tariffs on Canadian softwood lumber. Those prices were then given back as we got a little bit of increase in domestic production, but also due to the housing soft patch that we experienced at the end of 2018 and 2019. The current data, I've only got it through the end of March, but the current data indicates that lumber is running about $350 per thousand board feet. It went down below that and then kind of came back up in April. We think it's kind of going to hover off there at about 350, although we are hearing about lumber mills shutting down due to expected decline in construction activity as we go into the spring. All right, the other short run factor on the supply side is whether home building and remodeling has been deemed essential. This is a key area that state associations, local associations, and their advocacy efforts have really paid off, and it's another reminder of why membership matters much. Look at this map, and I should note that New Jersey, you need to make red. There are 6 states where home building is not an essential business. So you got Washington State, you've got Michigan, and then you've got that northeast cluster of Vermont, New York, Pennsylvania, and New Jersey. Those states, home building and remodeling, except for some limited exceptions related to affordable housing production, which is homeless shelters and low-income housing tax credit type multifamily housing. Those red states represent a little more than 10% of single-family homes that are currently under construction and a little more than 20% of apartments under construction. So while we expect starts to go down, I think it is important to keep in mind there are about 500,000 single-family homes that are in the construction pipeline right now, and more than 600,000 apartments. And for 90% of those single-family homes and about 80% of those apartments, construction is ongoing, and therefore home building is providing jobs and providing an important source of economic activity during this shutdown period. In terms of building our forecast, this is the NAHB Wells Fargo Housing Market Index, the HMI. It's our monthly builder confidence measure. It's what we use to do our short run forecast for single family starts. The index is a 0 to 100 measure. Anything below 50 is considered negative. In March, it was at a level of 72. In April, it fell to a level of 30. This was the biggest monthly decline in the history of the index, which goes back to 1985. It was the first time we had fallen below the break-even level of 50 since 2014, and the 30 level marks the lowest it's been since 2012. it is correlated with single family starts. So it's a pretty good predictor where we're going. And right now it's kind of pointing to about a 400,000 to 500,000 annualized pace for single family construction at the national level, based on builder confidence as measured at the start of April. So mindful of that, I'm going to walk you through then our forecast. Here's a single family construction. Right now we're expecting about a 20% decline for 2020. We think the second quarter is going to be particularly bad. People ask me all the time, am I expecting a V shape or a U shape or even a W shape recovery? Well, for the overall economy, I think I'm probably leaning more to U. For single family construction, we've got V, but it is based on some assumptions, including things like the availability of financing to private builders being available. The way that we've got this modeled, we have a sharp decline in the middle of the year, and then we slowly kind of come back to trend, and we don't really get back to where we were until roughly the end of 2021. So we're going to be in recovery mode. I think it will begin to take hold in the fourth quarter of this year, but that recovery is going to take some time to get back to the prior post-Great Recession trend line for single family construction. And something to keep in mind, we're going to have a recession in 2020 without a doubt, but we do enter this particular recession in a very different place for housing than we did for the Great Recession itself. When we entered the Great Recession, we were overbuilt on housing. Today we're underbuilt. And as an example of that, if you look at the data from the 1980s, 1990s, and the early 2000s, we were building about 41,000 single-family homes per year per million population in the United States. Pretty constant measure over 3 decades. And then over the last decade, for reasons related to the supply side headwinds, that pace fell in half. The result is that we're probably short about 1 million residences in the United States based on demographic demand and the need to replace older housing. So we're in an underbuilt position. And for that reason, we think the forecast will want to get back to the trend line. It's really just a question of how quickly it can do so. And that is related on things like financing and labor availability. But it's this argument, this data, that we're basing the argument that we're making to policymakers, particularly in Washington, of the idea that home building can be a sector that helps lead the economic rebound as we go forward. Here's our apartment construction forecast. We're expecting more than a 10% decline in apartments. I think we may be a little too optimistic on 2020 for multifamily construction activity going forward. The reason being that I'm hearing a lot of concerns about things like elevators, for example. Elevator parts are in short supply. It's difficult to get elevator inspections. And without being able to do that, that becomes a showstopper for apartment construction. I see a question about the uncertainty in the mortgage market. I actually went through the mortgage forecast. We can talk about that a little bit more in Q&A if you have some details. But right now, I think in terms of the mortgage market, we are seeing a tightening of the credit box for potential buyers of homes. The FICO scores are certainly going up. The liquidity seems to be in an okay position because Fannie, Freddie, the Federal Housing Finance Agency have made sure that the flow of credit is available. And the most important impact that's happened in the mortgage market is the Federal Reserve, through what we're calling quantitative easing 4, has bought mortgage-backed securities in large numbers, and that has held down the mortgage interest rates. I think the thing, and we'll go back actually to single-family starts here if I'm talking about the mortgage market, the challenge in the mortgage market really is not the low rates, it's the ability to save a down payment. And that's going to be a challenge when we are facing an unemployment rate that could range from 14 to 20%, depending on what forecaster you're listening to, and the ability to save that down payment when people have wage cuts or furloughs. So it's going to be the down payment requirement that I think is the binding constraint on people to be able to qualify for a mortgage and buy a home. And so one of the advocacy policies that we're discussing right now in Washington are ways that the federal government can help, particularly younger households, save for a purchase of a home and accumulate that down payment faster when we get a recovery. Okay, so going back to apartments, do keep in mind that about 95% of apartment construction is built for rent. So this is a built for rent market. There's very little condo construction that's taking place. And then the last part of our forecast is on the remodeling market. Remodeling market, I think, is going to fare a little bit better than single family construction and multifamily construction, but there will be important divides. The interior remodeling type projects are likely to suffer because we see in the survey data that people are reluctant to bring people into their home, particularly worker crews during this virus issue. But exterior remodeling and repair activity should actually fare a lot better than other parts of the US economy. So we have a decline in 2020 for the remodeling market, but it is smaller. And we think the remodeling market, just like in the Great Recession, will fare a little bit better as we go forward. And we've got a sharper rebound for that part of the industry. And then I just wanted to end with, I've talked about all these virus impacts, but I think it's important to remember it's an election year as well. And this would have been a topic that we would have been discussing in a lot more detail this year. But this is some data. We take the home building data from at the county level, and we mark out red and blue counties. So no surprises here. The red counties are counties that voted for President Trump in 2016. The blue counties are places that voted for Clinton in 2016. I think it's useful to remind ourselves that the regulatory burdens still matter, and they will matter even more in an eventual rebound. 61% of single-family construction takes place in the red counties. So most single-family building is in the red areas. Not only that, but if you look at the growth rates in 2019, which are on the right side of this slide, the growth rate for single-family construction in the red counties was almost 2% in 2019. And it was down more than 1% negative growth in the blue counties. So land use rules, regulatory burdens really matter in terms of building. And why am I including this here? Well, if we think about a rebound and the idea that maybe people want to seek out lower density environments, exurbs, outer suburbs, rural areas, those places are a little bit easier to build because they have more flexible regulatory rules. And so a housing rebound, to the extent that it changes the geography of construction, could be helpful as we move forward. And then using that kind of same data, this is the same map, but for multifamily construction. In multifamily construction, most of it is in the blue counties, not a big surprise. 68% of it is in the blue counties. But the growth rates are kind of interesting here. 24% growth rate in 2019 for apartment construction in the red counties, 7% growth rate in blue. So apartment construction in 2019 was growing in both places, but growing a lot faster in the red counties, again, because of those regulatory environments. So just kind of to wrap it up before maybe we'll take any additional questions that anyone has. We're currently modeling about an 8-week pause for the economy. So we think that will continue into May. Ultimately, we will get control of the virus. It'll occur either through herd immunity or through science and capital and markets, which would be antiviral drugs, a vaccine deployment. But this will end. We will get through it. Maybe a baby boom as a result of people being home a lot more, or more divorces, again, depending on which perspective you want to take. But I would keep in mind this kind of 2-month, 2-quarter, 2-year targets in terms of trying to think about the impacts. The next 2 months are going to be rough. The economic data are going to be terrible. Over the next 2 quarters, we will see stability. And then over 2 years, we're going to have a rebound and get into recovery mode. So mid-year economic performance will undoubtedly be very weak. The second quarter data will be terrible, but we are expecting a bounce back after we get through that period. And a lot of it's just going to depend on the virus itself and how governments respond to that. So that wraps up my kind of forecast looking at the economy, where we stand with the virus and the housing markets. And I'm happy to take any other questions that you might have. Frank, I'm not seeing any other questions. I don't know if you want to.
Yeah, I guess that means your presentation was so thorough and educational that there's nothing left.
Yeah, I either stunned them or bored them into a.
I have a question.
Yes, please.
Where do we get your slides? Do you have that someplace where we could get that and print it off?
Yeah, I will email Frank a PDF of this deck.
Perfect.
And there's a question from Rob Jones, who spelled his first name like I did many years ago. I used to go by ROBB. Any updates on servicing industry and the liquidity issue? The Federal Housing Finance Agency is in a fight with the servicers, with the Mortgage Bankers Association, and frankly, with the housing industry in more general in terms of not setting up any kind of relief for servicers. The issue here is that with the mortgage forbearance rules, which are helpful because they are going to prevent a flood of foreclosure properties, which will help support home prices. But in the meantime, those servicers still have to forward payments of principal and interest. They have to pay insurance payments, taxes, and the like. And it's estimated that if we get to a 25% forbearance rate, which I think is a little high, I think 15, 16% is probably more realistic. We're at about 5% right now. That there will be about $100 billion gap for the servicers. And that could really cause a problem for the mortgage availability. Federal Housing Finance Agency offered some rules yesterday where Fannie and Freddie will help purchase some loans. Mark Calabria, who is the head of the Federal Housing Finance Agency and a libertarian economist who got his start as a NAHB economist a number of decades ago, is trying to hold firm. He doesn't want to bail out the servicers who maybe got more aggressive than they should have been. But I think there's a lot of pressure to try to help that industry and make sure that that hole is filled in. I think slowly but surely they're going to get there. They've made some moves that are helpful. They're not quite clear how helpful at this point, but I think that will continue to be available as we go forward. Some questions about availability. Then Rob also asked, for the unemployment rate, is there a profile of those who are losing jobs? This is a great question, actually. It has not come up. I'm doing 2 or 3 of these a day. I wish I had more time. One of the interesting things about where the job losses are being concentrated, it's not just that it's concentrated heavily in the service sector, but some of we've seen, for example, 26 million first-time jobless claims. Some of those numbers are not going to push up the unemployment rate as much as some people have suggested, and I've heard 30% unemployment rates. I don't think that will happen. And the reason why is there's a lot of people in those groups who are in the gig economy. So Uber drivers, DoorDash deliverers, things like that, although DoorDash deliverers should be in high demand right now. But the other thing is when you look at the data on the age of people who are losing their jobs, it's a lot of people under age 45. And the reason why is that the initial job losses were concentrated in hospitality, transportation, restaurants, places that have a lot of younger workers. That was the concern about people not paying their rent. The National Multifamily Housing Council put out some data a couple of weeks ago where they found that about a third of people who rented their housing were not paying rent. That was a kind of questionable figure. They've been updating as it goes along. Our tracking suggests maybe rent payments are down 4 to 5%. I think they've come down to raise their 30% number to about 8%. But the principle of it, the concern, was definitely an issue because you had a lot of young people who rent who were losing their jobs and whether they would pay their rents on their apartments. I think over the long run, the fact that the unemployment is being concentrated among younger people is going to have an impact. One is political. The risk of the virus is mostly to older people, although it affects everyone. But the economic pain is being felt by younger people. That's a political issue that's going to go forward in terms of the economic justification of shutting down the economy and hurting one group of people to the benefit of another. I don't want to get involved in that, but I do think from a political perspective, that conversation is going to take place at some point. From a housing perspective, what it means is that a lot of the prospective first-time home buyers are the ones who are losing their jobs. And that's why it's important that we move from stabilization fiscal policy to stimulus policy that helps those people not only get jobs back, and I'll mention something about getting their jobs back in a second, but also then helping to restore their wealth, because we've got to make sure those people can get a down payment. If they want to move out of New York City and get away from the subway system and buy a house, we've got to make sure that they have the option to do so, particularly if they're having children. The other issue is something that's come up over the last couple of days about the unemployment benefits. And I don't want to get too political on this, but the decision was made by Congress to make really, we'll say, generous unemployment benefits. Well, the problem with that is that some of the unemployment benefits are actually higher than the wages of the jobs that were being lost. So much so that the restaurant industry has said that a lot of restaurants aren't going to open until August 1st in some of the hard-hit areas in the Northeast and on the West Coast, because their workers simply would rather have the unemployment benefit than do the job. That's a problem. Now, I understand the motive for having really generous unemployment benefits was the idea of letting people pay their bills, and if they can pay their rent and they can pay their mortgages, that helps keep the banks and real estate owners in business until we get into a rebound. But it would be very bizarre if we get into a situation where we have really high unemployment, but employers are saying, I can't fill the jobs that I need to fill in order for the rebound in the economy. That's a pending issue, and it is going to have to be addressed going forward. Another question, do you see digital technology is going to permanently change how homes are sold? We do. And in fact, I have a lot more survey data. I didn't go through a lot of it, but it was interesting in terms of both using technology, online home tours, whether it's existing homes or one-on-one tours of model homes or using digital technology. We found about a third of home builders were reporting some kind of digital walkthrough process for home buyers. It was also interesting to see how home builders were using technology in communities where it was allowed to enable things like virtual inspections. About 20% of builders have told us in surveys that virtual inspections by local engineering offices, third-party certifiers were being permitted. I think that's going to grow. One of the challenges that was identified up front when we went to this kind of shelter-in-place environment was the idea that you needed wet signatures on a lot of real estate documents. Well, Fannie and Freddie quickly changed some of the rules for that and allowed electronic signatures. So I think the digital technology of the actual real estate process is going to change. That's going to have impacts on how builders do business. It's going to have impacts on how existing home sales are done by realtors. And then it also sets the stage for changes in home design. One of the challenges we're hearing in Washington, D.C., for example, is that a lot of employers were old school, I think for good reason, and resisted having office workers work at home. Well, that has been challenged. Obviously, it's been required. And so the question is, how much telecommuting will happen in places that had terrible traffic? So Washington, D.C. has got terrible traffic, as does Los Angeles, as does Atlanta. If you have more teleworking, you're only going to the office 2, maybe 3 days a week, maybe you can drive till you qualify further out because that cost of commuting goes down. I think that's going to have an impact on outer suburbs. I think it's going to have an impact on the inner suburbs as well, that we could see a pivoting from rental housing demand in the central cities to more medium density environments. And I think that would be generally positive for things like tear down construction in older inner suburbs, as well as townhouse construction for people who don't want to live in a tall apartment building. They want their own front door, so they don't have a common space, but they're still looking to be close to the center of the city. And I think that's kind of a bullish indicator for townhouses and inner suburbs. Do you think the SBA IDL is a viable loan for small home builders? I will address the PPP loan program because that's the one I've been more involved with. There are some challenges. We have some limited survey data. It's not particularly deep, but thus far, I think about half of home builders have tried to apply for a PPP loan, and maybe about a quarter have actually been approved. There's one technical challenge with the PPP program, which is that it appears to rule out speculative home building. Now, I've heard of spec home builders who have been approved, but the letter of the law and the regulations that they pulled from the Small Business Administration, and they just took rules that were off the shelf, appear to rule out speculative enterprise. And the original rules were from programs from decades ago that were meant to rule out like speculative energy type investments. Jerry Howard, CEO of NHB, Jim Tobin, the chief lobbyist at NHB, and Dave Ledford, the head of regulatory affairs at NHB, have been working night and day over the last few weeks to work with the SBA, the Treasury Department, and the White House to make sure that all the home building industry can qualify for those loans. I think the greater limiting factor is the fact that the money keeps running out. They just recently refilled the program. We will see, I probably a round 3 of funding, but there are some issues in terms of the availability. And one more broader issue that I should mention, Jerry Howard, the CEO of NHB, is on the President's Recovery Council. I believe he is the only trade association rep from the housing industry on that. And he is in literally daily contact with the White House. So if you have concerns or things that we need to bring up to the federal level, please do let your executive officers know, and they can get in touch with the advocacy staff at NHB to take those issues straight to the president, quite frankly. And I don't see any other questions. Do we have anything else pending?
I don't think so. So if everybody's had their fill, then we're just gonna hand it back over to Doug, let him say goodbye to everybody. And just want to let everybody know, as soon as we've got the recording available, we'll put it up on our website. We'll send a notice out to the entire membership about where they can get a hold of it. And then once we have these, we'll make these slides available as well. So all this should be available for everybody to see pretty soon. And of course, the recording should include the slide presentation as well. So I've got nothing else. If Doug, you want to say goodbye to everybody. Thank you, Robert. We appreciate your time.
Robert and Frank for putting this together. And I hope everyone got something from this presentation. And I hope everybody stays safe and has a good rest of their day. Take care.
Robert, thank you very much.
Absolutely. Yeah, happy to do it. Hope it was useful.